following is an update and technical analysis on Eli Lilly, a company of the healthcare sector and drug manufacturers based upon the daily interval. In addition, I will additionally be deep diving into the much larger picture within the monthly time frame, and we had some fundamental headlines rock Eli Lilly in discontinuing Baqsimi, which is their third product within their diabetes sales lineup. Eli Lilly, which has been featured in the IBD leaderboard portfolio, is gaining attention with the anticipation surrounding tirzepatide complementing Mounjaro for diabetes and Zepbound for weight loss, recently approved by the FDA, and I believe it could be the fundamental catalyst for the buy the rumor, sell the news, and we are starting to have the broad continuation of bearish candlestick pattern formations and additional falling three method bearish continuation patterns that are just continuing to construct and establish here within the daily interval. And what now has been constructed is a beautiful head and shoulder classic looking top with which I would consider the neckline based upon multiple moving averages in the 50 exponential and 50-day moving average. We have a huge volume price indication around this range where we additionally put in a well-defined aesthetic looking a falling bearish continuation pattern. And this is what I'm starting to get here. And to the first sign of a bearish continuation pattern, we have not the most aesthetically pleasing, but then again, one that mimics the nature of an additional falling three method bearish continuation pattern. And here we are, alpha whipsaw-like reaction on an undercut of the 50 exponential and 50-day moving average, only to close right back above it in a what I would consider a big monumental key transitioning point for a much larger bound to move to the downside upon breaking this key inflection point. Huge volume around this key range here, and this is what I see now. In addition to the previous video I made, we again off this bearish rising wedge pattern, we are starting to take that level out. We had a nice clean, put in a diversion high. We had negative and bearish divergences constructed on multiple price technical indicators with nothing but red candle closes below the zero line threshold here on the oscillator histogram, and we completely took that level out. We had a minor backtest, consolidated in this tight trading range, had an additional backtest, creating a great risk reward ratio short trade setup to the long side, and thus far the entire trade has been good for a 4% drop to the downside. And I've added a new minor reactionary low uptrend line, which will be more than a correlation of the head and shoulder classic looking top of the neckline. And if and when we go on to take that level out, if you took that starter position where I had this primary uptrend line created on the October 19th, 2023 year, and this was the catalyst for a nice key inflection point for a great entry point to scale into. And that has been met with a fury of selling on a hard rejection, retest and or backtest at the bottom of that primary uptrend line. And I believe the gates will really start to open if and when we undercut those reactionary lows off the 50 exponential moving average, only for an additional first target there, revisit of that first target, 554.27 price support for an additional, in the entirety of that trade would be good for a 7, close to 8% drop to the downside. Target 2 to the top of the gap there for 16.5% crash. And I believe, again, we are trading at a key inflection point. We'll add that new bearish falling three method continuation pattern, the secondary phase in that key inflection point. Once again, repeating the bearish candlestick formation and a counter snapback, strong counter trend rally, snapback rally right back up to the top of that primary trend range. Call it the 608 to 609 level to 610 would additionally offer an additional add-on to your existing position, if not an entry to your risk reward ratio short trade setup to the downside for additional targets to be met, a correlation with the 200 exponential moving average. So again, we are breaking down not a hard sell signal, but definitely one that needs to be respected at all costs. Long traders, bull traders, they want to see a solid recovery, take this level out, retest the primary downtrend line based upon the mid-October reactionary highs there, completely take that level out to go on to re-challenge the negative and bearish divergences that were constructed on all three technical momentum indicators for a big short squeeze move to the upside if and when long traders are able to recover and thrust into a big series of momentum to the upside. As for now, I'm still sticking with the trade on a hard short trade setup to the downside, only increasing the odds for a much bigger drop.